All right, let's talk about Canadian taxes. Now, I know. For a lot of people, the tax code feels like this big, scary book of rules designed to take your money. But what if I told you it's also a rule book that's absolutely filled with opportunities? That's right. Today, we're going to decode some of the most important strategies out there, from big life changes to smart long-term savings, so you can legally and very effectively keep more of your hard-earned cash. And just a quick note before we dive in, all the material for today's explainer was prepared by Dr. Samir Alrishani with some help from AI support. So, I have a question for you. Do you dread tax season? I think most of us do, right? But what if we could flip that script? What if you started to see the tax code not as a burden, but as a playbook? A set of rules that, once you understand them, can unlock some pretty significant savings. Well, that is exactly our goal today. We're here to hand you the playbook for some of the most common and most important financial situations you'll face. So here's the game plan for our session. First, we'll build up your basic tax toolkit. Then we'll dive deep into deducting life's major moves. Think moving for a new job. After that, we'll put two smart savings plans, the TFSA and the RRSP, head to head. Then we'll tackle the trucky rules for family transfers. And finally, we'll wrap it all up with your key tax planning takeaways. All right, let's get into it. First up, your tax toolkit. Now, in Canada, figuring out your tax isn't just one step, it's a process. You start with your total income, right? But before you get to the number that really matters, you get to apply this special set of deductions called Division C deductions. And let me tell you, these are powerful. Why? Because they directly reduce your net income. That's the number the government actually uses to calculate your tax bill. So a lower net income means a lower tax bill. Simple as that. So what's in this Division C toolkit? Well, it covers a whole bunch of things. We're talking about really significant life stuff like moving expenses, the cost of childcare, spousal support you might have paid, and of course, your RRSP contributions. For today, we're going to zero in on a few of these that really come into play during those big pivotal moments in life. Okay, so let's do a deep dive into one of the biggest and honestly one of the most misunderstood deductions out there, moving expenses. The rules can seem a little complex, so to make it all crystal clear, we're going to walk through a real-world case study from start to finish. But before we even think about adding up receipts, you got to know there are three, let's call them golden rules, that you absolutely have to meet. First, the move has to be for an eligible reason. So, a new job or going to school full-time. Second, your new home must be at least 40 kilometers closer to that new job or school. And third, and you really got to pay attention to this one because it trips up so many people, the total amount you can deduct is limited by the income you earn at your new job in that specific year.
Okay, so with those rules in mind, let's meet our case study, Elaine. She just landed a great new job, but it means she's packing up her life and making a huge move, all the way from Halifax, Nova Scotia to Regina, Saskatchewan. This is a perfect textbook example of what the CRA calls an eligible relocation.
So what can Elaine actually claim? This is where it gets interesting, and there are a few surprises. The obvious stuff is there, gas for the car, movers, storage units. But here's the big one that a lot of people miss. You can deduct the costs of selling your old home. We're talking real estate commissions, legal fees, the whole shebang. And you can also deduct the costs to buy your new home. Now, there's a catch. You can only claim those purchase costs if you actually sold a home back where you used to live. And what can't you claim? Things like house hunting trips you took before you decided to move, or, and this is important, any financial loss you took on the sale of your old house. The CRA doesn't cover that. Now here's another one of those tricky little rules that you have to know about. We're talking about temporary living expenses, so hotels and meals, either near your old place or your new one. You can claim these, but only for a maximum of 15 days. That's it. So let's say you're in a hotel for a week before you leave, and then for 2 weeks when you arrive. That's 21 days total, right? Well, you can only claim 15 of them, so you'd pick the 15 most expensive days to maximize your deduction. All right, let's run the numbers for Elaine. We've got her costs for selling the old house and buying the new one. We've got the gas for that long drive. We've got the moving company and storage. And we've got that 15-day max for her meals and lodging. When you add it all up, look at that. The total comes to a staggering $24,119. That is a massive potential deduction. But, and this is the crucial twist, remember that third golden rule we talked about, the income limit? Well, here's where it comes into play. Elaine's got over $24,000 in expenses, which is amazing. But because she moved later in the year, she only earned $16,500 at her new job in Regina. And that income, well, it acts as a hard ceiling on how much she can deduct for this tax year.
So what happens now? Is all that extra expense just lost? Well, no. And this is the good news. Here's how it works. Step 1, we know her total expenses are $24,119. Step 2, we know her income limit is $16,500. So for this year, step 3, she deducts the smaller of those two amounts, the $16,500. But what about the rest of it? That's step 4. The leftover amount, that's $7,619, she gets to carry that forward to next year. She can deduct it in 2025 as long as it's against income from that same job in Regina. So she doesn't lose a penny of the deduction in the end.
Okay, so that's a perfect example of how a big life event can create a really valuable tax deduction. But what about being proactive? What about planning for the long haul? For that, we need to turn to the two titans of Canadian registered savings plans, the TFSA and the RRSP. Now, to really get the difference between these two, we have to talk about a core concept called tax deferral. This is the absolute engine that makes the RSP work. Think of it this way. You're not avoiding taxes, not at all. You're just postponing them, pushing them down the road. You get a nice tax deduction today for contributing, and you only pay tax on that money when you pull it out, which is usually in retirement when, hopefully, your income and your tax rate are a lot lower. And really, these two accounts are like mirror opposites. It's all about when you get the tax break. With an RRSP, you get the break up front. You contribute, you get a tax deduction right now. The money grows tax sheltered, but you have to pay income tax on everything when you take it out. The TFSA is the complete reverse. You get the tax break at the end. You put in after-tax money, so no deduction now, but here's the magic. All the growth, every single penny it earns, and all of your withdrawals are 100% tax-free, forever. So one is tax deferral, the other is more like tax elimination on all the future growth. All right, let's move on to a topic that can get, well, really messy if you're not careful. We're talking about transferring assets, like a cottage, a property, or even company shares, between family members. You see, when you're dealing with relatives, the CRA says you're not at arm's length. And because of that, a whole special set of rules kicks in to make sure things are done fairly.
And, the logic behind this makes a lot of sense when you think about it. If two strangers are making a deal, they're going to fight to get the best price, and they'll probably land on whatever the fair market value is. But with family, well, you might be tempted to sell your son or daughter $1 million property for, say, a single dollar, just to avoid paying capital gains tax. And yeah, the CRA has rules specifically to stop that from happening.
This is exactly why trying to get too clever can really, really backfire. Let's look at the most common trap: selling below fair market value. Let's say a property is worth $500,000 and you sell it to your child for $400,000, thinking you're doing them a favor. Well, the CRA steps in and says to you, the seller, nope, we're going to tax you as if you sold it for the full $500,000. But here's the painful part. For your child, their official cost is only the $400,000 they actually paid. Can you see what happens? That $100,000 difference, it ends up getting taxed twice. Once for you now and again for your child when they eventually sell. It's a terrible outcome. Really, the only clean ways to do this are to either gift it outright or, you guessed it, sell it at its true fair market value.
So what's the big takeaway here? It's simple, really. When you're transferring property between family members, just stick to the fair market value. Trying to get creative and using any other number, well, it almost always leads to some kind of tax penalty. It's just not worth the headache. Okay, let's bring it all together. We've covered a lot of ground, so let's recap the most important lessons and turn all this knowledge into some concrete, actionable advice. So here's what you really need to remember. First, plan your move. That moving expense deduction is incredibly powerful, but don't forget it's limited by your income at the new job. Second, choose your savings tool wisely. Are you playing the long game for tax-free growth? That's a TFSA. Are you looking for a tax break right now? That's an RSSP. Third, transfer assets wisely. Seriously, when it's with family, just use fair market value. It'll save you from so many potential tax penalties. And finally, the most important point of all, being proactive is powerful. Just understanding these rules gives you the power to make much smarter financial decisions. And that's a wrap for us today. So I'll leave you with just one final question to chew on. Thinking about your own life. Right now, which one of these strategies could you actually use this year to make a real difference? Thanks so much for joining me.